Hi everyone. Today let's make the case for real estate in 2025 according to Fundrise. We've been talking about real estate and dividend payers on the channel for a while, and Fundrise is one of my investments, so let's take a look at it. Do me a quick favor and like and subscribe and watch the video till the end to help out the channel, and let's get started. So the case for 2025, they say interest rates will continue to fall, which should give real estate a positive market and positive returns. And the private markets more broadly, they say this is a positive tailwind for 2025. And I do tend to agree. I've been talking about this for a while. I think real estate and yields and yielding assets like REITs and bonds are the best place to be, at least in the short term. They mentioned the start of the cutting cycle here with 100 basis points, which has translated to positivity for basically every asset class, including real estate. The flagship fund did a positive return of 7.5% in 2024, which is not its strongest performance, but it is a good step in the right direction. 7.5% is nothing to scoff at, especially in the real estate space. And this is less than halfway through the expected cutting cycle. We've only cut 100 basis points, and we're expecting cuts over the next 2 years, assuming that everything goes perfectly well, which you never know, but that is the case for now. You also have the income fund and the innovation fund delivering strong performance for the year. And you can see here the income fund, I've been talking about it on Fundrise for a little bit. This is where I've been putting my money. Private credit has had a great return. Interest rates have been high enough and attractive enough for private credit, distributing 7.9% in annual dividends and a total return of 8.3%. Really good returns there. In their innovation fund, they say they've deployed about 66% of capital to their top 6 companies, returning 11.79%. Again, pretty good for the year. Obviously a little bit weaker than the overall markets, but nice returns there. And they also had their first IPO within the innovation fund, so they were invested in Titan, which IPO'd and the shares popped about 44%. So very good returns there. And then they start to talk about some of the negative things. They had some underperforming sectors, and they say the majority of this underperformance is because the assets in the fund are either under construction or in lease up. These funds hold low basis properties because they're either vacant or partially leased with temporarily negative cash flows, which did drag down their returns. So not everything is perfect. They did turn a positive return this year, which they didn't the previous. So overall, I think we're going in the right direction. They say 99% of investors did have positive returns for the year, which they hope to deliver going forward. And going forward, they do believe they are going to have strong returns. They think rates are going to continue to come down. We've talked about the dot plot before, but this is what it looks like out to 2029, back to that more reasonable rate here. So for next year, a couple of cuts here, 2027, somewhere between 3 and 3.5%, and then continuing to cut very small percentages all the way through here to 2029. They are a little bit all over the board, but for the most part, the center point is there at 3%. And then they talk about real estate pricings. Although stocks are up 57% over the last 24 months, real estate really has not gone with it, close to multi-decade lows on prices close to the 2008 crisis in terms of how attractive they are relative to the rest of the market. Again, I totally agree. I've been saying buy REITs. I think these yielding assets are going to have a better future, and as long as you can continue to compound with those dividends, should be in a good spot in my opinion. I like things that yield at least over the medium to long term, and that's what they're saying here. As investors, you should be focused on buying when prices are good, especially when you're buying for the long term, which can be 10 plus years. And then looking at that comparison back to the 2008 crisis, you can see markets have gone down nearly as much. This is in apartment values from March of 22 peak. They've gone down nearly 30% at the lows, just short of 30%. And so far they've recovered to about 20%. So makes sense why we've seen such a weak real estate market, at least over the last couple years here. But what they're saying is we've seen a slight recovery, pretty much in line with that 2008 crisis. And we're expecting to get back to at least another 10% gain over the next year or so based on this metric. Oversupply turned into undersupply as the demand for the resource has gone up, which is part of why we're seeing values start to go up. And you can see 2001, 2002, borrowing costs were extremely low, and you also had panic-induced inflation driving up rents. Buildings were still being built, and a huge supply of apartments became available, and that did drive down the markets. Now we're seeing that kind of level out to more normalization. Now we're seeing new real estate construction start to fall, at least on a seasonally adjusted rate, back down into those more normal levels. So if you're starting to buy now, over the next 10 years, we'll probably see those things appreciate. Again, this is a long-term investment. And then they talk about the new administration with Trump coming into office, talking about deregulation in the financial sector potentially being positive, tariffs, not sure how much that impacts them, reduced immigration, that could be interesting, maybe a little less demand, could affect them in a slightly negative way, and then hopefully lower taxes, which would be beneficial for everyone. Of course, there is no risk without returns. I think that goes without saying. But about 100% of economists predicted some kind of recession in 2023, and they were 100% wrong. And they did talk about how they also believed the soft landing was nearly impossible to achieve, which so far it seems like we've done. We did just see the re-inversion of the 3 and the 10-year. Talked about it on the channel when that happened, so maybe that recession is getting a little bit closer potentially, but so far so good on the economic front. They also highlight the fact that the stock market has had one of its best runs of all time over the last 24 months. Prices are really, really close to the 2000 dot-com bubble prices. You can see that here. Dot-com bubble got all the way up to about the 45 PE ratio, and right now we're at a 37.9, so very close to those record highs. Not quite there, but nearly there. And in terms of things to buy, the stock market is expensive. We've said it before. It's probably not the best place to park your money over the next 10 years or any term less than that. Over the next 10 years, you'll probably make money. They say here the annual return is about 3% over the next 10 years for the forecast, which is not a great return. Probably want to be getting into cash, probably want to be getting into bonds and real estate, and this is potentially one of the better places to do it, in my opinion. Moving over to my portfolio here, you can see it's right around 69,000. Net return 7,600 this year. 4.1% overall, better than the previous 10.5% down. Flagship fund 7.3, very good. Growth REIT 3, 7.7. Some of these development funds, like we talked about, the ones that are currently in development were negative. I think those will continue to improve over the next 2 years as those projects close out and we start to see some net positive cash flows. And then you can see private credit 7.9%, venture capital 11.6%. So pretty good overall. The weighted average was 5.1% for the year, and so far obviously 0 for this year. Weighted average venture capital is down 0.6, so minus 0.1, but 0.2 positive already for your private credit. It's been good returns there the entire time, so 3.4% continuing to put money into private credit with Fundrise. And honestly, I kind of just want to move all of the money over to the flagship fund. These ones are doing not so great, but on a dollar basis, you can see these are very small for me. So even with those negatives, it's only $130, $140. Very small on those because I just don't have very much money in those funds. The 7% here with the flagship fund was the majority of it with $1,200 there. And then venture capital, $500 with that. Private credit, again, I've been building that position over time. So it's not a huge return dollar-wise just because this investment is not that big so far. Let me know down in the comment section what you think of real estate and Fundrise for the upcoming year and potentially the next 10 years. Where are you putting your money? Are you buying the stock market at these high prices or are you stockpiling cash? Let me know. Otherwise, like and subscribe if you got any value out of this video. Make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.